I'm just going to jump in quickly now because I'm just trying to clarify a few things, right? Because there's a lot of concepts that are being shared right now, and you're talking very quickly about them. So to be clear, right? Scaling smartly is, and just to I could be wrong again, right? But scaling smartly is how you invest your launch capital and separating launch capital from trade capital. And just to confirm, trade capital is what you need to produce the thing which you're selling at the time. Launch capital is how you are taking the profit and spending it for future performance, right? And so what companies often do is they combine the two. They just think everything's an operation, and that's where the confusion is. So scaling smartly is how you choose to invest the launch capital versus the trade capital. Is that the best way to think about it?
In essence, you're sitting at the blackjack table, you're on a good run, and you're trying to say, well, this is the amount that I kind of need to hold on to, but here's the amount that I'm willing to bet. And I like kind of getting the entrepreneur to think about launch capital is a bet. I don't know if it's going to work. How many people have
So then is effective marketing or marketing, is that launch capital or is that trade capital?
So it's, this is this discussion that we have with entrepreneurs, and I mean, it almost comes up every day. And had a client on the call earlier this morning that said, they had some extra money. He says, what do I need to spend it on? I said, well, I mean, you don't need any cash. I mean, said your business is producing enough free cash flow that everything that they needed to grow their business with is an expense, but it's a finite number that would not drive them to a loss. So you just need to decide, what is the catalytic spend that is going to scale your business. Now, what we've learned from studying the growth path of all of our clients is this: the number one spend that it takes to grow your business is marketing spend. And that can come in the form of is it spending on marketing or people? That one carries kind of can carry a labor component as well. Mm-hmm. The other one is pre-spending on capacity, which generally is labor that's not fully utilized to then fill it up and sell into it. Now, in the scaling process, so the black hole that I talked about in the first book of between $1 million and $5 million of revenue is painfully real. And $3 million of revenue is the deepest, darkest moment of the black hole. And the reason for that is it's where the next person or the next catalytic spend that you have to put out is far more significant to your overall financial picture than it is when it's $5 million or $10 million or $20 million. Mm-hmm. And so you got to get through that period before the catalytic steps that you take aren't so critical between an edge of life and death, of the business, and where you can't afford to miss. Whereas I can afford to miss if I'm at 10 million and I try the next test of something in that process. But then what it really came down to is 90+% of the things that we spend money on to grow are an expense. It's not a capital asset. It's not a piece of equipment. It's not a building. It's not a plant or a factory, or those kind of things. I mean, those that can be, but even if you do those things, there's a way to look at it from a practical standpoint of, framing the return on investment of my choice to spend. Because I want the thing that struck us was, it kind of goes back to what we say, there's 4 types of capital. 3 of them exist on your balance sheet. 1 of them hides on your P&L. And I think to me, that's kind of discovering, the ninth planet of the universe. In a sense, it was sitting there in plain sight. We just didn't have a telescope strong enough to see it. Okay, well, the reason why is we had our mindset saying capital means balance sheet. No, it doesn't. I'm producing profit on my P&L and then making choices to redistribute that profit into something that I didn't need to spend on to create what I'm currently doing. Every person that runs a business listening to this podcast, I want them to stop and think for a moment. What did you spend to try to grow the business in the last 12 months that wasn't needed to be spent to produce what you did in the last 12 months. You spent it to get to someplace else next. That's not a current operating cost. It's an investment in the future. It just happens to be on your P&L. And so what we've done is try to design techniques, and you'll see a couple of these examples. Like we've got the launch the term we named the baby is the capital component on your P&L is called launch capital. It's an expense that I use to launch an activity, whether it's a business in total, a segment, the next new customer, or whatever that. So the key is putting words to it to give people, kind of like what we did with LER in the first book of Labor Efficiency Ratio. We've named the baby. So there's two critical names that we really came up with in the new book. One of them being trade capital, which is that key component of that cash that just turns over, AR, inventory minus AP.
Yeah.
That component, it's a slightly different derivation than working capital. But to me, it's the accurate way of looking at, hey, this is the cash piece, this investment piece that as the business gets bigger, that dollar amount's going to get bigger, but it's going to stay in relation to my revenue.
I'm just going to jump in quickly now because I'm just trying to clarify a few things, right? Because there's a lot of concepts that are being shared right now, and you're talking very quickly about them. So to be clear, right? Scaling smartly is, and just to I could be wrong again, right? But scaling smartly is how you invest your launch capital and separating launch capital from trade capital. And just to confirm, trade capital is what you need to produce the thing which you're selling at the time. Launch capital is how you are taking the profit and spending it for future performance, right? And so what companies often do is they combine the two. They just think everything's an operation, and that's where the confusion is. So scaling smartly is how you choose to invest the launch capital versus the trade capital. Is that the best way to think about it?
In essence, you're sitting at the blackjack table, you're on a good run, and you're trying to say, well, this is the amount that I kind of need to hold on to, but here's the amount that I'm willing to bet. And I like kind of getting the entrepreneur to think about launch capital is a bet. I don't know if it's going to work. How many people
So then is effective marketing or marketing, is that launch capital or is that trade capital? So all sales and marketing is launch capital because you don't need them to satisfy your current customers. Is that?
Yeah. Unless you're in a business that literally nobody's going to come to you without, you're in a transactional business. And if you don't market, nobody comes through your door. Well, so to a certain degree, and this is what we do with our online retail clients, we consider direct marketing of social media, pay-per-click, those kind of things. That's actually a cost of goods sold in the way that we look at online models. Now, marketing for branding, awareness, content, those things, that's launch capital, in those, because you can get by without spending anything. And it won't optimize the business, but you'll keep getting business from that other. Most of the rest of service businesses, people that have a brand, they're known in the community. I've got an oil change client that literally, whether they market or not, somebody's going to drive past their place, see it says oil change, and they'll go in and get their oil change.
Sure.
So but if they want to drive new activity, find new customers that don't know about them, that's launch capital.
So then if I am looking at my P&L, right, and I've got a net profit, right, I actually don't have a true trade profit. This is a trade plus launch profit, right? And so what would you recommend as an action for people to do to really get the true number of how much is the business required to spend to just operate with the existing customer base and how much to spend on growth? Like how do they separate this out?
So there's two techniques, and we go through those in the launch capital chapter of the 2.0 book. So we show one technique where you're intentionally making this decision and evaluating the results. So that's one where it's actually a client that allowed us to share their exact data. And so it was a client that grew from 700,000 in revenue and in 5 years grew to 10 million. And the only catalyst was they increased their marketing spend each year. and then they evaluated the increase in net profit from that increase in marketing spend. So notice this is the difference. This is one of the weaknesses that you get in the marketing arena. It is
because this is the difference of net profit based on marketing spend, not the actual total net profit. Is that right?
Yeah, I don't care how much your revenue went up, because you had other ancillary costs that had to be added to support that additional revenue. So those are what we call reflection cost. That they're an echo of the initial catalytic activity. And so what you're really trying to get to is what was my net gain? And I want to recover the cost of my investment plus 50% or more on top of that original bet that I made. And in the example that we show in the book, it worked 4 out of the 5 years. 1 year, they just got their money back. They kind of missed. They put too much money in and hit that point of the marketplace that says, you can spend all you want, but we're not moving anymore because of it. You've tapped out the effectiveness level of that marketing spend.
So you're really, I think, like you talk about in the book, return on invested capital. Is that right? Is this right? Is this what we're talking about right now? Is this like
this is a subcomponent of that. And so there's an overarching return on invested capital that we now use. When I did the original book, I had an observation of profit levels, and I made a statement in the first book, and also I restated it in the chapter I wrote for Vern's book. At 5% profit, you're on life support. 10%, you're good. 15%, you're great. Anything above 15%, take it while you can get it, because the market will compete you back. And that works for about 70% of the companies out there. But it was the 30% that I had to do some kind of excuse to say, why didn't that work? Because I had clients that had 3% profit that were nicely profitable, but it's like, why? And so I kept studying it, and fortunately, through my EO organization, they let me chair an executive ed program at Horton. So I always say it's kind of nice that they let a kid from a chicken farm in Alabama hang out with like real professors. And I had to give all the credit to David Wessels. He was the one that really turned me on to the idea, and I don't think he really knew what I would do with it, because he didn't have access to the data I had access to. So I've got access to private companies. All he has access to is a college professor, even at one of the premier learning institutions. He only has public company data. I got news for everybody out there. There's a public company. It does things for different reasons than we do in the private real world. And so that's why I'm focused on the private business community, because you do some crazy stuff when it comes to public stock. And so, but financial concepts are what they are. And so I said, okay, well, I had to define what do I think is the minimum standard of return on invested capital for private companies. And I established, to me, 50% return is the minimum viable standard. I've got a couple of clients below that number, but they can get to 50. I've not modeled a North American company yet that couldn't get to 50. There's some that don't get there just because they're making bad choices, and it is what it is.
Just for the listeners that are not across the concept yet. So invested capital is what? Could you just clarify?
So invested
capital. Yep.
So let's start with equity. And this was a point that Professor Wessels made that I thought was quite clear. He said, equity is a flawed calculation. And he's absolutely right. What you got to do is look at the equity of your business and make a couple of adjustments. Do you have the appropriate amount of cash? So I make a big deal about you need 2 months of operating expenses in cash. So if I'm operating at less than full capitalization, I got to take equity and plus it up for how much cash really should be in the business to meet our minimum capital standard. Secondly, then you start adjusting plus or minus. Do you have any assets that are on your business balance sheet that aren't necessary for the operation of the business? Fixed asset, related party loan, whatever. Intangible assets, which really aren't real. They were just a plug number to buy something. So you take all of those things off. If you can't convert it to value for what it's stated, you take it off. Same thing on the liability side. Do you have debt that really is unrelated? Maybe I took on an investment round of mezzanine debt. Well, that was just an investor putting money in for me to take some money off the table, and that really didn't create any value. It's just kind of there. So to me, I take that out of it. So I'm looking at true operating liabilities and accrued expenses and operating debt, line of credit, term debt on hard assets, those kind of things. Once I make those adjustments, that number is my invested capital of a existing operating business in that process. Once I get that clean invested capital number, then I look at my net income before taxes, and to make it universal globally, I want to stick to a number that's pre-tax, because everybody's got different taxes.
Sure. Yes.
So let's take taxes out of the equation. Let's say whether I pay taxes on or not, what is the pre-tax return on this asset? And that's what you're looking for. And that
changes frequently, though, doesn't it? That changes like that. Well, it should change frequently depending on how you're spending or how you're investing your capital or spending your money, right?
It does historically until people focus on it. And what's amazing is, so this has kind of been a passion of mine, is I see people start a really good business that's building value, and then they get distracted. And I mean, just imagine an entrepreneur that's, attention deficit. We all are.
Yeah.
And we start chasing the shiny object. And I kept looking for how can I present the incredible value of what this business is that's in front of them and get them excited about it as an investment. And that's why I make a big deal to separate. Here's the job that you get and the income that you get off of the thing that you do. But let's really nurture this business as an investment and stop doing business activity that just provides you a job. And let's do business activity that is a phenomenal leverage to create value. And so Alex, if you said, hey, I got $100,000 that I'm looking to invest, and I says, great, you give me $100,000. What if I give you a 50% return? Is that a little better than what the bank or the markets are doing?
At 2%, at 1% these days too.
Yeah. So you give me $100,000 a year from now, I give you your $100,000 back plus $50,000. Oh, by the way, you got to pay tax on that $50,000 because it is taxable. But depending on your tax jurisdiction, you've got probably at least $130,000 to reinvest. Here's the dirty, honest truth. 50% returns the minimum. Most of our clients operate between 75 and 100%, some as much as 200% return. And this is really kind of the explosion of understanding, categorizing business operations in terms of understanding a business's return on investment potential. So I'll give you a great example. Probably the best return on invested capital business model we work with is in the IT managed service environment, so MSPs. And those guys, if they run their model correctly, so one, they've got monthly recurring revenue for the fixed services.
Yes.
They'll occasionally bill for projects and activity of those existing customers.
Yes.
But if they do it correctly and get money up front so that they're not out of pocket any of that cash, they're one of the leanest capital structure businesses, because all they need to operate from a capital perspective is their 2 months of operating cash and a little bit of equipment. Most of them don't even have equipment. Everything's is in the cloud or lease kind of stuff. And so the average, we run a couple of mastermind groups for MSPs, and the top 25% of those companies in those mastermind groups have a 200% in return on invested capital. And so their only challenge is to grow.
But is that calculation based on trade capital, or is that trade plus launch capital? Is that combined?
Well, see, their trade capital is zero because they get paid in advance.
Okay.
So see, that's what makes
trade capital is a cash flow discussion.
It is.
Is that right?
Exactly. Yeah.
But just to clarify, right? Because
go ahead.
There's quite a lot of concepts here, but if you can change your cash flow strategy in terms of actually how you invoice your customers, your payment terms, that shifts your speed of scaling or your speed of growth significantly. Is that right?
Right.
And why is that?
Well, what you're doing is, like I said, you're taking away a barrier to growth, because when you start to quantify trade capital as a percentage of revenue, so traditional accounts receivable, maybe plus inventory with very little trade support, those businesses, 20% of revenue has to be sitting there in trade capital. And so in those cases, and we make a point of this, we call this the cash power ratio. If your trade capital percentage is at 20% and your profit percentage is at 10%, what it tells you is for every new dollar of revenue growth, I've got to put 10% of my money in just to get it started. If I can invert that and make trade capital 10% and profit 20%, I'm 10% positive cash on every new dollar of revenue. Which business do you think can grow faster? A business that creates positive cash with every new dollar of growth, or a business that has to go get bucketfuls of cash to keep throwing into the company? I've got this food distributor in Central America client that, I mean, it's just dreadful. I mean, it takes them, they have to pay for their inventory when they order it, and they have to wait 60 days to get paid by who they sell to. That's a bad business model. So it is for you.
Yeah, it's so on the face of it, and I'm going to check in now, because correct me again if I'm wrong, but on the face of it, it seems that you can scale faster if you change your payment terms, and so that for every new client that you get, it adds cash to your business instead of it kind of adds cost. Right? Is that the first part? Yes, but no. Yes.
But let me put it to you in a different sense.
Yes.
So my good friend Alan Miltz, he's probably, I don't know if he's done your podcast, but he's certainly known in the same community. Vern works with both of us, and we both contributed to his book. And Alan, talks about those components. And really, a lot of my thinking in 2.0 came from Alan and I do a lot of joint presentations together. And the thing is working on those individual components, the answer is yes. But here's the bigger issue. I've got to look, I can't just focus on AR. I can't just focus on inventory. I can't just focus on accounts payable. I can't just focus on deferred revenue. I can't just focus on profit. And so that's why we put it in relation. I've got to look at trade capital as a net number, because there's trade-offs in there. There's things that sit on the asset side and things that sit on the liability side that can net against each other. Okay. And so I want to give you more tools to say, listen, just look at the framework and say, if I'm at 20% trade capital and 10% profit, okay, what are my choices? Can I bring down my trade capital? I mean, that's obviously one of the things. But you may be in a market to where, as hard as you try, the answer is nope, that's just the way it is. And I'll share an interesting story with you in a second about that, though, breaking through bad thinking. But so then what you have to do is say, okay, well, let's shorten the gap. Let's get our profit up. So if I'm handed a trade capital in the 20% range, I just got to get profit up to 15, 17, 18 and narrow that gap.